And one, we're live. What's going on, everybody? Welcome back to Wolf. It's good to see all of you here. Chatting with Mr. Robert Infraa. As always, each week we jump on stream, pull up some of the charts. And today we have Bitcoin crashing pretty significantly right now. Quite an alarming rate, actually. In the last day, we are down 9%. Bitcoin has cracked below $70,000 on the month. We're down 28%. In the last week, we were down 20%. So Bitcoin has not had a good time lately. It has not been a good time for Bitcoin. Among other things, the commodities are doing their thing. But Bitcoin is back in the news, maybe not for the exact reason we were hoping for. But me and Robert are going to chat about and see, we're going to talk about all the things. So Robert, how are you, man?
Good. This is exciting times.
Indeed it is, dude. Indeed it is. What kind of things are you paying attention to right now? Do you think Bitcoin is the most important thing? I mean, I know it's going to be the only thing everyone's talking about today. But talk to me a little bit about what you think, what maybe could be behind some of this price action. I know we're talking about the oversold versus overbought a second ago off screen. And by the way, if you want to share a screen for anything, I'm happy to pull anything up.
Yeah, there's a lot. Let me share my screen.
Cool. And by the way, for
kind of
people
a
who are
lot
watching
going on
back at home, definitely be sure to repost the stream if you guys haven't already, or quote tweet the stream, tag a friend, let people know that we just got started. Also, big shout out to RexShares for sponsoring today's show. I'll just do this now because I know we're going to chat about some of the things later on in the stream. So I'll get your screen pulled up here in a second. But yeah, big shout out to RexShares for sponsoring today's show. And investors should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contains this and other info about RexShares. To obtain a fund's prospectus and summary prospectus, visit their site at rexshares.com. Their funds prospectus and summary prospectus should be read carefully before investing. Big shout out. We're excited to be working with RexShares, one of our longest running clients. There's a couple ETFs in there we'll get to in a little bit that are pretty interesting, especially with Bitcoin's price action lately. And so I'm excited to get to those later on in the stream. But I have your screen pulled up here, Robert.
Yeah, so, well, this morning we got job openings came in way lower than expected. We had initial claims come in higher than expected, and we had challenger layoffs come in at the highest level to start the year, going all the way back to 2009. Challenger, going back a couple months, has been showing weakness when it comes to the layoff picture, but generally when it comes to like unemployment and those kind of harder data, not seeing as much weakness when it comes to the labor market. It's kind of a low hire, low fire environment. But yeah, today bonds are getting bid super hard. So yeah, across the curve, 2, 10, 30, rates are down in a pretty meaningful way. So I think part of that is what's going on in the labor market. I think that we're also kind of getting a bit of a liquidity issue, and kind of there's most definitely some margin calls from kind of the forced selling that we appear to be seeing. Yeah, even silver's down 15.5%. There's lots of big moves. Here we're looking IGV, which is software. A lot of people have been posting this chart recently. Software has been getting crushed, as you can see from the red line there. Software is getting crushed. I think that the trade is probably pretty close to being overdone. It's all you hear about nowadays on CNBC, talking about, this particular trade. A lot of people are short software, long semis, kind of the AI trade. And yeah, I think that there's definitely margin calls. There's definitely some liquidity concerns and kind of forced deleveraging. You see implied correlations are up 25% to 17.9. Nothing close to kind of the spikes that we get during other bottoms, but implied correlations moving up mean that the move, the volatility, the dispersion of the volatility is you're starting to get closer to a kind of correlation to one where everything just gets sold kind of indiscriminately. As implied correlations move up, you're kind of getting closer to that point. We have the VIX at 22 now, it looks like. Still nothing like super crazy, not a 40, 50, 60 handle on the VIX, but definitely something to keep an eye on. S&P 500 down 1.5%, NASDAQ down 1.6. Yeah, it's kind of bloodbath everywhere.
Yeah, it is. No, this is honestly wild stuff, dude. I did not expect this morning when I woke up, and dude, it happened so fast. This drop, it feels like this is just how it's becoming. I mean, Bitcoin's always sort of been like this, but we're starting to see the commodities act like just irrationally, like in this way, where there's massive daily drops. It's just like the new norm, like this type of behavior, like massive. I mean, Bitcoin's not nearly as big as like a silver or something like that, but is this like the new normal? Is this what we're just? This is just like what's going to be happening from now on, just massive daily candles like this.
Yeah, I mean, I think volatility is going to be higher. I've been saying that since kind of late 2024. I don't think that ends anytime soon. 2025, that call definitely played out, right? We got Liberation Day amongst other kind of high volatility events. So yeah, I think, whether it be VIX volatility, whether it be political volatility, whether it be social volatility, whether it be go down the list. Volatility everywhere, I think, for the next couple of years is probably the base case. When it comes to like how much downside there is left on Bitcoin, I really have no idea. I kind of think that, maybe high 50s, low 60s is probably, but no one knows. I did a poll. I did a poll like a couple days ago asking people, because everyone is throwing out there, as I've been buying the past month or whatever. Everyone's like, oh yeah, I'll be buying, but not until this level.
Yep.
And the range was pretty wide.
Yep.
I had people saying, oh, it's going to 10K. I had people saying it's going to 30, all the way up to kind of 60 and even low 70. So I did a poll trying to figure out where most people have it stopping. But if you look at the RSI, it's the most oversold going back to March of 2020, obviously, with all the COVID insanity. You have volume starting to spike at least on Coinbase. I was checking that earlier. You have fear and greed index, which is the coin market cap is the one I look at. They use a proprietary model to calculate that, but they also include the options chain, I think on Deribit, not on IBIT, but on Deribit, and look at, call put skew. So yeah, that's showing extreme fear. You have the kind of waterfall price action. I would just point out, look at consumer staples. These things are going vertical, even in the bloodbath that we're seeing kind of across equity markets, across really everything. Yeah. Consumer staples are ripping higher. Wow. So it's kind of a defensive move, defensive posture. You had energy getting bid couple weeks ago. And oil is up. Geopolitical stuff is obviously on the rise again with what's going on in Iran. We don't really know what's going to happen there, but there's definitely been some tension there. There's been like developments. The U.S. Navy shot down, I think, 2 drones in the Strait of Hormuz area, wherever the carrier is. I'm not a Middle East geography expert, but we shot down 2 of their drones. They I think tried to take over a U.S. flagged merchant ship. So yeah, there's a lot going on over there. You get a spike in oil, that can cause other dislocations kind of on its own when it comes to both creditor nations of ours that obviously own a lot of U.S. treasuries that might be forced to sell that as their countries get pushed in a current account deficit, but also just inflation. If you pull up inflation oil, it's basically the same chart. So you don't want to see a spike in oil. I did close my oil longs pretty much at the top, which I'm grateful for. It's not to say that oil can't go higher. I think that I think it can, if we get, if the tensions continue to escalate over in the Middle East. I think you probably get a higher oil price, a sharply higher oil price, most likely. And that's generally not good when it comes to the bond market for those two reasons. Number one, the effect it would have on inflation. Number two, the effect that it pushes a country like Japan or France or the UK into a current account deficit because you need to import energy. You don't need to import. You don't need U.S. Treasuries. You can't run factories and cars and tractors on U.S. Treasuries. So the oil is definitely something I would keep an eye on. Currencies, nothing major today. Dixie's up a little bit. This Kevin Warsh stuff, I don't know. I think it's kind of funny. Just part of the reason that I'm buying the weakness in Bitcoin is because I think that a lot of this is probably due to the fact that the market was not positioned for someone like Kevin Warsh. The market was positioned for someone like Kevin Hassett, who is basically kind of a tool, to be kind, a tool. Both in the kind of pejorative sense, but also in the sense that he's just a tool of the administration, right? He was going to do whatever Trump wanted. And I think the market was probably positioned much more for someone like Kevin Hassett than it was for Kevin Warsh. Now, Kevin Warsh has been hawkish in the past. He has talked about taking the balance sheet down, significantly. I think I forget the exact date that he talked about it, but he mentioned the balance sheet going back to $3.5 trillion, which is great. Like, I would love that. The problem is what liability are you going to decrease? Because if you were to bring the balance sheet down from 6.5-ish, 6.6, if you were to bring it down to 3.5, you would have to reduce one of the liabilities. Well, the reverse repo is empty. Can't reduce that. Currency in circulation, can't really reduce that for a number of reasons. You have bank reserves, which technically you could reduce, but they're at 2.9 trillion. So you could reduce those by, say, 2 trillion to get some of what you need, and maybe the TGA to get the other kind of trillion that you need. You could technically do that. But the problem is, number one, when it comes to bank reserves, we know what happened when bank reserves started to get scarce back kind of Q2, Q3, Q4 of last year. We had all the kind of issues in the repo market. The repo market is responsible for funding the basis trade. The basis trade is responsible for absorbing 40% of all new U.S. Treasury issuance over the past 3 years, according to the Fed themselves. So yeah, you can't allow there to be dysfunction in the repo market, because that's going to put stress on the basis trade. And the basis trade, this highly levered basis trade, is responsible for buying all the debt that we're issuing. So you can't really, in my opinion, they're not going to be able to meaningfully reduce bank reserves without causing much bigger issues. Then you look at the TGA, the Treasury General Account. It's basically the checking account for the U.S. government. You could, right now it's about $1 trillion. You could theoretically take that to zero. The problem is, the TGA, just like, you and I want a buffer in our checking account to handle, a month or two of expenses, liquid cash in our checking account, just like we like to have that buffer. The U.S. government, the U.S. Treasury, who pays all the bills, they like to have a buffer too. The problem is that given how many T-bills we're issuing and therefore refinancing every month, 2 months, 3 months, 4 months, 5 months, 6 months, because of all those short-dated U.S. Treasuries, they're constantly rolling over. Every 5 days, we have about $600 billion worth of T-bill redemptions every 5 days. And so, if you're trying to have a buffer, if you're the U.S. Treasury and you're trying to create a buffer for, say, a 5-day shutdown of operations where everything, maybe it's a electrical outage or internet issue, or maybe there's some kind of violence or something, and you need to shut down for 5 days. You need $650 billion just to handle the redemptions of all the T-bills that are rolling over, every month or 3 months or 6 months, or, in short order. So you can't really take the TGA down. And I'm pretty sure too, when it comes to the TGA, there's a statutory minimum or requirement for the Treasury to have a certain amount of basically buffer in that in the TGA. So all that to say, I don't see how he would be able to take the balance sheet down to 3.5 trillion. I don't think he would even be able to take it down to 4 trillion. There is, yeah, I think that the hawkishness that the market's worried about, I think it's very misplaced. I wouldn't be surprised. I would be surprised if Kevin Warsh didn't promise President Trump that he was going to cut rates. I think that the overnight rate is still going significantly lower. We didn't just magically escape fiscal dominance. Interest expense is still 23% of tax receipts. You still have mandatory spending above 100%, above the total amount of tax revenue for the U.S. government. So, all those kind of issues are still running a 6-ish% of GDP deficit. So none of that went away. They need a lower overnight interest rate to refi, debt, because right now the average interest rate on all the marketable debt, 3.3. If you look at the entire yield curve, there's nowhere where you can refi at 3.3 or below, meaning that interest expense, which is $1.2 trillion per year, which is about $3 billion per day, is only going up unless they're able to get interest rates down. So again, it's kind of like a national security imperative that they get the overnight interest rate down, because I don't think they're going to be able to get the 30-year below 3.3. I don't think they're going to be able to get the 10-year below 3.3. So yeah, in order to stop the interest from growing, they need to get interest rates down to, if they could refi all the debt at 3.3, that would stop the increase in the interest expense. But other than that, the interest expense is going to continue to grow at about 15% year over year rate of change. And that's not sustainable when it's already 23% of tax revenue, when it's already, $1.2 trillion per year. They have to get that overnight interest rate lower to therefore get T-bill yields lower so that they can then roll the debt, refi the debt at lower rates. That's still, again, nothing changed when it comes to the fiscal picture, which is that interest is out of control. They have to get that down. It's really the only kind of major budget outlay item that they can cut. And I still think that over the next year or two, overnight interest rate is going significantly lower. So hawkishness, like people, the market appears to be to some degree, worried at least a little bit that Kevin Warsh might actually talk about hiking interest rates. It's like, there's no way, in my opinion, there's no way that he's going to be nearly as hawkish as people are worried about. A lot of those hawkish statement, number one, we just went through, can't really reduce the balance sheet to 3.5 trillion like he says he wants to do. There's just no way to reduce any of the liabilities that much. So it's impossible. So on that side, on the interest rate side, they have to cut interest rates. When you look at the fiscal, when you look at the math, they have to. Yeah, I think that a lot of the concern that appears to be in the market right now, when it comes to Kevin Warsh and his hawkishness, I think is mispriced. I think it's totally kind of off the mark. Like, they're still going to cut interest rates, and when it comes to the balance sheet, maybe they do reduce it a little bit, maybe. But there's kind of this growing school of thought that the balance sheet should grow in line with GDP. So if because again, the balance sheet is the asset side, and what that means is something on the liability side is also growing at GDP. That's bank reserves, for example, which is kind of what it would probably be. The monetary base, or half of the monetary base, currency being the other half. So yeah, there's kind of this like growing thought that you're hearing a lot more over the past couple quarters, that the balance sheet should grow in line with GDP, and that bank reserves should grow generally in line with GDP, which means that the balance sheet's not going down. If anything, it's probably going to kind of grind higher. And that's, all of that is assuming that there is no deflationary shock. If there's a crazy deflationary shock, then the balance sheet is going way higher. Interest rates are going way lower, So like, I see all the risks when it comes to, for example, the balance sheet. I think that, anyone worried about the balance sheet getting, going down to 3 or 4 trillion, I think that's way misplaced, that concern. Anyone concerned about the overnight interest rate, I think that is arguably even more misplaced. So yeah, I don't see the reason for the market to be freaking out, about Kevin Warsh and his hawkishness, which means, right, that, it's part of the reason Bitcoin is selling off, part of the reason, Dixie's probably squeezing. But what that also means is that Bitcoin is mispriced. If you have the market concerned about this hawkish Fed chair, and I just went through how he can't be nearly as hawkish as people think he wants to be, then what that means is that Bitcoin down here is mispriced. Now, if there's something I don't know about, if the Bitcoin network suddenly started missing blocks, or right, if there's some other issue, right, the Bitcoin supply is going to 25 million or something that I don't know about, then maybe it's not mispriced.
Right.
But if this is due to perceived hawkishness, I think it's mispriced. So I'm buying it.
Yeah, I have a couple follow-ups there. By the way, Robert, I threw the X stream link into the private chat if you wanted to share that out. But one thing that was interesting is so I have a couple follows. But first off, you mentioned with Bitcoin's reversal, one of the ETFs over here from Rex Shares, who's sponsoring today's show, was BTCZ. This is a 2x inverse Bitcoin daily ETF, which is a fascinating one, which obviously has performed very well this past 6 months because Bitcoin has not done so hot the last few months, I'd say. Like this ETF is up like 118%. There are many, like depending on if you're an investor or a trader, obviously if you're an investor, you're picking up price spot positions at any price for Bitcoin. But if you're also in the trading world and you see other opportunities, there's literally, there's a bull market everywhere for those who are deep enough in the trenches. So this is a really interesting one here. I am kind of curious on, you mentioned that Bitcoin was potentially mispriced here. On where you think a price point that makes more sense. Like, I guess I have 2 questions. They're kind of opposite directions. So maybe I'll start with the Bitcoin one. But people have kind of looked at that and been like, at what level does this thing catch some type of bid for the bulls and start to reverse here? But if we get continuation of that, we still have like months until Warsh is in. It'd be May until he gets in, right? And so would it be continued like discouragement, I guess, until then? Or what do you think happens for the price of Bitcoin?
Yeah, I mean, I think Bitcoin is leading. I think that's, most people will agree about that. The Bitcoin is kind of a leading indicator. But, we're seeing it with silver and gold too. Silver down another 15%-ish today. Gold down.
That was actually where I was going to go too. So I'm glad you went that direction too.
Yeah. So, like part of what I've been telling people, I want to add to my gold and silver, mainly gold, not as much the silver, but a little bit. But yeah, I've been saying like, a move that we saw last week of that magnitude is probably going to take, like, I don't think it was a one day and over kind of thing, especially with Kevin Warsh and the, whatever is going on, kind of deflationary, growth scare sort of stuff, kind of in other corners, whatever's going on there, like all of that is going to take weeks, if not months, to really digest. So, maybe I might miss the low on gold and silver. It might just reverse here, but my gut is I don't have a clear indication right now on gold and silver. Sometimes I see it, sometimes I'm 50-50. This is one of those times I'm kind of 50-50. I would expect, kind of lean like we're probably going to see more downside on gold and silver. It's probably going to continue to kind of digest for another at least couple weeks, if not a month or two. But yeah, I'm not 100% sure when it comes to gold and silver, but Bitcoin leads. So, I do think that Bitcoin has been leading some of that kind of, concern.
Sure. That makes sense. Yeah. Well, I guess in the meantime, for you guys who are interested in counter trading for the time being, you have all sorts of ways you can do that. But that one from TR, so that was pretty interesting.
Yeah.
An inverse ETF. I was like, dude, a double X inverse. I'm like, brother, we have too much degen behavior going on now.
Well, yeah, it's a good hedge. I mean,
yeah,
you can, I prefer options, but those sort of instruments, like you can hedge without this is why part of why I like options is
Oh my God.
that you can hedge with a lower amount of capital.
Yeah.
But yeah, no, but a 2x or 3x levered inverse, if Bitcoin pukes, you're
Yeah.
going to get, you don't have to put as much capital in to hedge your position to get the same benefit from the hedge.
Yeah.
So yeah,
100%.
I if I was smart, I mean, I feel kind of dumb because like from April, it was like a Liberation Day time period. That was kind of when I stopped buying Bitcoin, all the way up until I think it was like might have been the low 90s or the high 80s was when I started to kind of start buying again. It's like that whole time that I was building cash, I wasn't medium to long-term bearish on Bitcoin, but I kind of, I wouldn't have been building cash if I thought, that it was going to rip to 1 million. I
Right.
would have been buying. And so, there was a part of me that kind of knew this was coming, which is why I was building all the cash that I was. And I should have hedged. I should have bought some puts on IBIT or something, but
Mm,
I don't know why. I don't know why I did, but those are. I mean, if you were hedging with puts or 2x, 3x inverse, you're probably not worried that much. I yeah. Personally, I'm not worried. Personally, I love this because it's cheaper Bitcoin, and again, it's mispriced off what I just laid out when it comes to what the Fed's going to do. Like none of the things that we've been talking about for the past 2 years changed. If we
right.
are like take the deflationary growth scare angle, if we do go into a recession, if that is what the job openings and the challenger job cuts and the initial jobless, all those, if we are really going to go into a contraction, an economic contraction, a growth scare, well, the deficit is going to be 15% of GDP. That's a lot of bond supply. We've seen increasingly that the dollar has not functioned as a safe haven. This has been increasingly obvious over the past couple of years. We're not seeing kind of traditional dynamics behavior out of things like US treasuries, out of things like the dollar. So, to expect that in the next growth scare or the next recession where the deficit might very well be 15% of GDP, at least, to expect that treasury yields are going to go down. I don't know. If you look at the past couple years, there's increasing evidence that the dollar is not behaving the way it always did. That's usually how it happened, right? You'd go into a recession, bond yields would go down. You'd have kind of a bull steepener in the yield curve. Here, for example, is here we can look at 2008. So this is 2008, and I'll take the spread off here. You had rates falling, but falling the fastest at the short end. That's typically how a recession develops in the bond market. You have rates going down all across the curve, but they're going down the fastest at the short end. That's called a bull steepener. The difference, the gap between the long end rate and the short rate, that gap is growing wider. That's steepening, and generally that's what happens. Going into a recession, we can look at .com as well. That's also what happened for .com as well. You had rates falling, but they were falling the fastest at the short end. But that is not really what we've seen recently. What we've seen recently is, sure, a steepening of the yield curve, but look at long end rates since the Fed started to cut. They've gone up. The 10-year yield has gone up. The 30-year yield has gone up. 5-year, is it 5-year? Yeah, 5 years gone up too. So it's a bit of a twist steepener kind of from the 2-year under, but generally, the call it the 2-year looks like the 2 years just marginally higher than it was when the Fed started to cut. So from the 5-year or probably the 3-year all the way out to the 30-year, rates are actually going up in the face of Fed cuts. That's not normal. We've never really seen that before. So, yeah, I think to assume that in the next recession that rates are going to go down in the face of 15% of GDP deficit, fiscal deficit, I think that that might be giving the traditional behavior, giving the dollar and the U.S. Treasury and the way it always was. I think that to assume that it's always going to be like that is probably dangerous. And so you could get a situation where we're going into a recession, very akin to emerging markets, and rates are actually going up, which is like you don't want to see that. That is common in like kind of emerging market debt crises, balance of payments crises. You see rates actually going up as growth is going down. You see rates going up. It's the exact opposite of what you want to see. But the U.S. has, I think it's much more consensus. I've been saying it for years, but the U.S. is functioning much more like an emerging market in a lot of ways, and that's becoming a consensus viewpoint more and more, as time goes on. But we just saw it recently. We've seen it a number of times going back the past kind of 2 years or so. We've seen the U.S. function much more like an emerging market than it has the reserve currency issuer, which kind of raises all those, traditional beliefs and it puts them into question. If we do go into recession, are bond yields going to go down across the curve in a typical bull steepener? I don't know. Jeffrey Gundlach doesn't seem to think so. He's a pretty smart guy. So,
That's a pretty wild statement. Like the U.S. acting more like an emerging market rather than the issuer of the global reserve currency. Wow. I don't think I've ever heard anyone say. I don't think I've ever heard anyone put it that way.
Yeah, I mean, it's something I've been pointing out going back to like late 2024. But yeah, if you're open-minded and you're observant, I think it's pretty impossible to deny. For example, Liberation Day was kind of a perfect example. You had a growth scare, arguably one of the biggest growth scares or negative growth shocks in a long time, and you have bond yields go vertical, right? Remember, we had the 10-year U.S. Treasury yield go up by like 80 basis points. So yeah, and we had the dollar get sold, and we had the kind of major stock indices get sold very hard. That is like textbook capital rotation, capital flight out of a country. We didn't see the dollar get bid. We saw the dollar get sold. It's the same thing if you go back to the EU tariff and the Greenland BS that we just saw recently. If you go back there, it was the same story. The dollar didn't get bid during that kind of, tariff tension, Greenland, NATO, right? All that,
Right.
the dollar, kind of geopolitical uncertainty. You didn't have the dollar get bid. You didn't have U.S. Treasury yields go down. Bonds got sold and the dollar got sold. And what was up? It was the Swiss franc. It was the euro. So yeah, I think to assume that in the next recession the bond yields will just go down like they always do, I think that that's kind of dangerous given what we have seen over the past 2 years. And I think that, in a situation where you're already kind of at a 14, 15, 16% fiscal deficit as a share of GDP, but you also have rates going up, well, that very quickly becomes a 17, 18, 19% fiscal deficit, which very quickly feeds on itself in a kind of reflexive feedback loop. And that's, that's end game stuff. So,
damn, dude, talking about end game stuff, and the only thing
I'm not saying that is what is going to happen. I'm just saying that is because if you're a bondholder and you see a 15% of GDP deficit and you see the bond market selling bonds and you see bond yields going up, you get into a reflexive cycle, and the higher yields go, that pushes interest expense higher and higher. Higher interest expense pushes the deficit higher and higher, so more bond supply, right? You might go from 15% of GDP bond supply to 17%. Well, 17%, a GDP bond supply, again, that's more bonds that must be issued each and every year just to keep the lights on. More bond supply equal demand. or maybe even falling demand, you get lower bond prices. Well, lower bond prices, higher yields means higher interest expense. Higher interest expense means higher deficit, and it just goes on. Fees on. It's reflexive. So that is. I think a real risk. I don't. It's not my base case, but I think that given the way that the dollar has behaved in kind of situations, arguably even before Liberation Day. I mean, I really kind of first started talking about this kind of stuff. I want to say late. In December before that Liberation Day in January, February, you could already see that the rest of the world was kind of starting to get a little iffy about dollar denominated assets. But here's the EU, the Greenland stuff. Dollar got dumped versus the franc. Everyone was piling into the franc. And by the way, the Swiss have negative rates, so their 2-year is negative 10 basis points. So you don't even get paid to be in the franc. At least with the dollar, you have what, 3.25, 3 1/3 interest rate, short-term interest rate. In Switzerland, you have negative interest rate. So you are paying to hold the currency. And so, the fact that the franc strengthened as much as it did, given the fact that they have negative interest rates and we have 3 1/4, that's telling you something. And same thing goes, with the euro. Same thing goes with, to some degree, before Takaichi, it was the yen as well. But yeah, the dollar, just because it was like a certain way, for 50 years, does not mean that it'll always be that way. And I think you have to be open-minded to when things start to act differently from the way they used to always be.
Yeah. Interesting. Is there is there a world where, okay, in my head, I can't see a world where the US dollar can remain the world reserve currency, especially if all these assets and risk assets that we sort of are put in a position where they have to go up forever against the dollar. Like, I don't know how those two go hand in hand. And by the way, I saw a comment somewhere, and if you guys are looking for that 2x inverse Bitcoin ETF we were talking about, that link is in the tweet down below the stream, by the way. But in what world do you think are we able to have both? Is my first thought. And then my second one is, like, how is there a world where the US dollar can remain the world reserve currency in 50 years?
I don't think it's a question of want. I don't think it's a question of will. I think it's a question of desire. We don't want to be the reserve currency. They're trying to balance trade. They have said this many times, that their goal is not to reduce the trade deficit, but to eliminate it. Well, if you eliminate the trade deficit and you balance the current account, you're not exporting dollars to the rest of the world. So you are effectively telling the rest of the world, we are done with our international obligation as the reserve currency issuer. Also, of course, strong dollar and the recycling of those dollars back into U.S. treasuries, into U.S. equities, all that kind of that flywheel that we had going for a long time, that's over too. And so, I think we kind of got to the point where finally an administration kind of had the guts to, speak the truth when it comes to, they're very bad at messaging. They're horrible at messaging when it comes to dollar stuff. But yeah, Dutch disease and Triffin's dilemma and all those sort of concepts are very real. And some of us have been talking about it for years now. You finally have an administration that is willing to accept those facts, and I think we've realized that we don't really. It's not serving the median American anymore to be the reserve currency issuer, right? So it comes down to a question of, like, can we? Sure, I think sure, but do we want it? And I don't think we do. I don't think the median American wants it. I think, Wall Street wants it. I think the top 1% want it. I think, the Beltway wants it. Alexandria, Virginia wants it. Manhattan wants it. But, like, you talk to the median American, that their entire town was hollowed out and became a rust bucket, with a fentanyl addiction right through the roof. I don't think they really care. I think if anything, they're like, no, let's try something new. That didn't work. And so, yeah, this is the first administration that's really kind of, at least in my lifetime, has kind of talked about the issues with the structure of the monetary system when it comes to international, the international monetary order. And I think that they're on the right path with that. It's going to be very volatile, and it's also not going to happen like, when people talk about the reserve currency and the dollar and all this kind of thing. It's not going to be a sort of situation where we wake up tomorrow and there's hyperinflation and the dollar is being used as origami paper. Right. Like it's not how it's going to play out. It's going to be a gradual sort of thing around the margin for the next decade, 2 decades, maybe even 3, as the rest of the world kind of de-dollarizes. I mean, we've seen this with gold overtaking U.S. Treasuries in terms of
that was my thought with gold.
Yeah. We've seen it with the dollar share of FX reserves, which has not fallen below gold, but is falling. And look, China just said that, number one, their currency, as I've been pointing out for months now, their currency is strengthening versus the dollar, now at a 3-year low. The dollar is at a 3-year low versus the yuan. They are letting their currency strengthen. They have said just recently, I think it was Xi, said that they would like to become more of they've been talking about internationalizing the yuan for a long time, for years. And, he didn't say anything that revolutionary to those of us that have been watching this sort of thing. He didn't really, that comment got a lot of attention, but it wasn't anything super new, that he would like to see the yuan kind of gain in adoption when it comes to FX reserves and that sort of thing. It not really that shocking. They're trying to stimulate domestic consumption, just as the U.S. realized that we kind of got too far away. We went too far in the hyper financialization, hollow out our industrial base, hollow out our middle class, hyper globalist. Just as we realized here in the U.S. that we went too far, well, on the other end of the spectrum is China. They went too far as well, and arguably we funded it, which is kind of a whole separate discussion. But they have been realizing for years that they're reaching kind of their terminal state when it comes to the subsidized export dumping, kind of overcapacity sort of model that they have. They've been realizing for years now that they have gone too far in that direction, which means that there is a opportunity for the two countries to kind of meet in the middle, where they become much more, they try to reduce that kind of export dumping sort of economic model, stimulate domestic consumption, let their currency strengthen, and try to gradually restructure their economy, just as we are trying to do kind of the opposite over here, which is, maybe start saving a little bit more money, instead of running, such insane deficits, and build up our industrial capacity again, maybe, run a little bit more balanced trade, just as we're kind of coming to all those realizations, China as well. So yeah, there's it's not going to be, the kind of thing that you snap your fingers and wake up one day and it's all different. This is going to take, a long time to play out, to fully play out. And it's not to say the dollar is going to go away. It's not to say the dollar is going to weaken to the point of toilet paper. The dollar will still be held in FX reserves. The U.S. Treasuries will still be held in FX reserves. The question is, at what rate? If you look at like foreign held debt versus total government debt, that stopped increasing. Like 15 years ago. So that sort of thing, back here in 2013. So, other countries will always buy U.S. Treasuries. Other countries will always buy our debt and hold dollars and transact in dollars. I will note commodity transactions denominated in dollars, that share has been falling, right? People talk about like the petrodollar and commodity transactions and in dollar terms and stuff. it is true that a large share of those transactions occur in dollars, but that share has been falling. But it's not to all of that. It's not to say the dollar is just going to go away or cease to be any kind of. I think we're just moving from the dollar is the reserve currency, the U.S. Treasury is the reserve asset, to much more of a landscape where there's a bunch of reserve currencies, right? FX reserves, you look at it, and 10% are yuan, 25% are dollar, right? Like to 15% euros, like much more of a kind of even distribution. Gold,
but that'll have
is
some type of effect, right? Like there is like a benefit we get to being the global reserve currency. Like what things do we lose from no longer being the global reserve currency? Is there anything that comes to mind that would be?
Well, imports become more expensive. You when you're talking about like a weaker dollar regime, like a Dixie at 60 or 70 or something, imports become more expensive. So from a domestic inflation perspective, your imports from the rest of the world become more expensive. Therefore, it's inflationary. But on the other hand, a lot of people talk about that component, but no one ever says, but then on the other side of it, your exports become more competitive. No one ever mentions that. Sure, imports from China, those, Alibaba trinkets are going to get more expensive in a weaker dollar regime. But do we need more trinkets? Do we need more plastic Chinese stuff? I think we're pretty maxed out here in America with the cheap Chinese plastic stuff, just personally, but I don't know, maybe people disagree with that. You also get, kind of a reversal of a lot of the Dutch disease that started to develop when vis-a-vis the dollar, where, right, we would run a huge current account deficit, huge trade deficit, export all these dollars out to the rest of the world, and they would reinvest them into U.S. financial markets, right? U.S. treasuries, real estate, equities. And that hollowed out, as we became more and more financialized as an economy, certain areas did very well. Wall Street did exceedingly well. Insurance, financial services, that sort of thing, real estate, those corners of our economy did very, very well. But, at the expense of others. So you would get a reversal of that. The flywheel where the dollar is always strengthening versus your native currency, and our markets are always going up, and you have positive carry there. You're making money both directions. Everything's good. You're making lots of money. That flywheel kind of starts to maybe slow down or maybe go in reverse. And so, it could have profound effects for or implications for, equity market and potentially the U.S. Treasury market. So it's not without consequence. There's definitely consequence to trying to unwind, 50 years of this economic model.
Yeah, of course. And I see Landy is down there in the chat as well. Shout out to you, Landy. He's saying, glad that Robert is one of the few talking about this. Yeah, I agree. There's not a whole lot. And then I see XRP Town Hall saying this is boring. Sorry, brother. These are the things going on in the world, unfortunately. We could just pump XRP. What do you think, Robert? Should we just change the title and just start ripping on pumping XRP to the moon and see how that guy's doing?
Oh, man. I understand why he's upset.
Oh, God. XRP Town Hall, brother. What happened? If it loses that little midline right there, that's a pretty big cliff to 50 cents. I was talking to Thomas about this yesterday on the stream as well. I don't know why XRP came up.
It's
looking
like,
at it.
Yeah, like Solana looks like that too.
Yeah, interesting.
Just this like huge. It's a pretty ugly chart, to be honest.
By the way, speaking of charts that aren't looking phenomenal, there was one here. MSTR, if you see it. I have it pulled up on this side as well, but if you want to pull up on TradingView, that might be a better chart.
Oh, man.
Yeah, MSTR is not looking hot, dude. It's down 10% today. I mean, I guess that's obvious because
beta works both directions.
Yeah, seriously.
Leverage works both directions.
Rough.
Yeah, I'm glad I didn't go long. Remember we were talking about it here.
I remember. Yeah, a little bit.
November.
Yeah, we were eyeing it at that level. We weren't fully sure because we're kind
Yeah.
of waiting to see what the King Bitcoin was going to do first. But
It did look kind of waterfall-y.
yeah,
And generally I like those like crazy capitulation sort of setups. I mean, Bitcoin was kind of doing that too. That kind of accelerating sell-off on increasing volume. See, this is at least volume on Coinbase. You see increasing volume, you see kind of an increasing like a curve, like a parabola, like a downside parabola. Those I generally like. But MSTR, there's just something about it that like, I don't know. Just I don't feel super comfortable about.
Yeah.
Even a lot of people that were bullish MSTR that were really into all that, back before, even they're kind of like skeptical
I
and
know,
urging
dude.
caution. And
But what about the other ones? Like we have STRs, like the ones that are giving like a payment on each month kind of thing.
oh
Like my
yeah,
fear has always been like you hold the thing, you're like you're happy, you're getting paid out per month, but the stock goes down. So it's like, do you even end up making money? And that was always my fear
well,
with assets like this.
yeah. So you in TradingView at least you can do an adjusted chart.
Okay.
So this shows you the like if you bought STRC, this is going to show if you click this button here, adjust data for dividends, it's going to adjust
Oh,
and
wow.
factor in the returns you're getting from the interest, if that
Okay.
makes sense.
Very
So
cool.
it's the same thing as like TLT, right? This is the long bond ETF. So this is what it looks like. Long-term treasuries have a yield associated with them. This is what that chart looks like. Here's what it looks like without dividends reinvested. See, it's much lower. So,
Interesting.
yeah, you definitely want to when you're looking at like a dividend company or that sort of thing, you definitely it can radically change the way the chart looks. Like this is TLT, the long bond without dividends reinvested. It looks pretty bad.
Yeah.
This is with dividends reinvested. Factoring in the yield that you're getting. So yeah, when it comes to like STRC and all that kind of stuff, the whole complex kind of there's just something that's always bugged me about it, and a little bit about him, like as a person, not trying to go down that road, but like there's just kind of I don't know, and I'm just trying to trust my gut when it comes to that. But
Yeah, of course. Wow. Yeah, dude, that is interesting. There's a lot of assets right now that are tied to. I don't know if you look at Coinbase recently.
yeah, Robinhood too.
Dude, it's not good. I'm like, wow. I asked this. I don't remember if this was in a space or a stream. It might have been Landy or Thomas. I don't know. I talk to like the same 9 people every single day, so it's one of you folks. But like, I asked, I was like, how big of a hold does Saylor have in this market? Like, if Saylor has a big oof moment or something goes wrong there, I'm like, how bad is that going to be? Or is it backwards? Is it Bitcoin has this movement and then Saylor's sort of beholden to Bitcoin kind of thing? I just don't know because there's so much. There's a lot of big money, I think, in strategy, right? And so like, I just don't know like what kind of foothold it is, and which direction it is. Is it strategy leading? I assume it's Bitcoin leading. But I mean, dude, at this point, Saylor and Bitcoin are almost synonymous to the average person who's in Bitcoin. They know Saylor, and vice versa.
Yeah, I'm not sure. I mean, one thing I will say is like I don't think, I don't care really to kind of go down the rabbit hole on MSTR.
Yeah.
Like some people do, but from what I've gathered from the people that I trust that have gone down the kind of super in depth into MSTR, a lower Bitcoin price is not necessarily gonna like cause them to go insolvent, cause them to they're sitting on an unrealized loss right now.
Right.
But as long as they can issue they're not like the people saying, oh, Michael Saylor is going to go bankrupt and he's going to be forced to sell all of his Bitcoin because Bitcoin went down in price.
Yeah.
I mean, at least the people I trust are saying that's not correct.
Yeah.
And look, like, I think there's also, maybe it's because I wasn't buying Bitcoin up here,
Right.
at 100 or above, maybe it's that, but like, I don't know. The fear seems way overdone. like the fear and the panic and all that, like I don't feel that way.
Yeah,
Anything,
I
I'm
hear you.
excited to buy more cheap, you can get more Bitcoin for the same amount of dollars.
That's the thing, right? Like like with Bitcoin specifically, with all assets, but like specifically with Bitcoin because the volatility, like you really find out if you like the asset or not, or if you really figure out why you bought the thing in the first place when the price goes against you. Because like you said, you were like I think we were talking about wages or earnings or something like that, and you were like I forget what the analogy was that you pulled up. It was like it's like if your wages are going up in priced in Bitcoin. I forget what the terminology was, but basically you were like you have to frame it correctly if you're going, especially if you're going to be an investor in Bitcoin, because if you like the thing, it's going to go up and down. I mean, Sailors tweeted it. Volatility is a gift for the faithful.
Yeah,
And
like it
often priced with gold. Like you're not. Well, I guess now it's different, but like oftentimes with gold in the past, you weren't getting that retrace to get into a lower price. Bitcoin, you do get those opportunities, and nothing changes about Bitcoin just because
yeah.
it's F&D.
Yeah, if you were buying Nvidia, if you really like Nvidia and you think that they're great and their earnings are going to grow and whatever, and you're buying at 149 and nothing changes about the underlying company business,
Yep.
then you should love to buy at 125 because you were bought, nothing changed,
Yeah.
and you were buying this asset, this equity at 150. So why would you not be excited to buy? Which raises the question with Bitcoin, did anything change? Not that I'm aware of. It's still scarce. It's still the network is still running fine. The blocks are still like nothing changed. So, Bitcoin has a lot of volatility. I think, I don't know. It doesn't really bother me.
At this point, it's becoming just like every other asset. Like the fact that silver is moving 5-10% in a day. Gold was at 55,000 something, and like these guys are moving now, and so it's
silver,
like,
yeah.
I don't
That
even
was a
know. It's
crazy
like
move in
it's
silver.
almost hard to say Bitcoin's volatile now. Now that we're seeing the biggest assets in the world move with the same type of volatility as Bitcoin.
Worse.
Yeah, it's
worse.
crazy.
Silver, that move on silver
God.
is worse. When was the last time? I mean, Bitcoin, I think, touched negative 10% today earlier.
Yeah.
But right now we're
Briefly.
about -7. This was a 35% at the low. It was a 35% move. So yeah, look, Bitcoin's not been doing well for sure, but like, has it had a 35% day? Look, if Bitcoin had a negative 35% day, that might be something to be worried about, but it's not, like it's I don't know. I also remember like way back, it wouldn't even be on Coinbase probably. Like, I don't know. I remember, back when I didn't know anything about anything, I remember watching like, 10-20% moves in a day, like way back.
Yeah.
And it's just, I don't know. Like, I don't care about the volatility. I'm not levered. If you're levered, you're going to care, and maybe you should not be levered. Because leverage, you're definitely going to care about the volatility, but I don't not yet, using leverage. So, there probably will become a time, to maybe think about like, a 50% LTV loan to buy more. I don't know.
Yeah, we'll see.
Maybe.
I see Landy saying he wants STRC to come down further. Interesting. Looks like Landy's getting in the STRC game. I did a podcast with Gary Cardone yesterday. We talked a little bit about STRC. He really liked the idea there, especially since it's going to give you way more yield per month than anything else that you could get with your bank. He had some interesting views, I will say. And Robert, I know we got to bounce here in a few minutes, but any last things you want to throw in there, or things you're paying attention to this week? Got the end of the week coming up. Tomorrow's Friday, and then weekend. But
yeah,
I know the weeks fly by.
No, I mean, I would just say probably watch rates. Still pricing in kind of a bit of a look. The labor market could very well deteriorate. And if we do really go into a recession, there could definitely be more pain for Bitcoin.
Sure.
But I think two of the most important things to remember is people don't generally talk about this, but I think that your cost basis, I've always brought it up in these streams, your cost basis and your time horizon matter a lot. My cost basis right now on Bitcoin is 52K. My time horizon is 10, 20, 30 years, like very long. I think a lot of people have a much shorter time horizon. If you have a much shorter time horizon, then yeah, maybe like buying Bitcoin here is probably not smart. But like, I think that, maybe you go short, there could very well be more downside. I'm ready to buy, but like maybe that's not the right move for you if you have a shorter time horizon, because there's very possibly more downside with Bitcoin. But my time horizon is very, very long. Like, I don't think in 10 or 20 years that buying at 60, what did I buy it earlier? 67.5, I think. I don't think that that's going to be a mistake in 10, 20 years. The other thing too is, like, with Bitcoin, there might come a point where it is prudent and smart to sell your Bitcoin for dollars. I don't think that that's anywhere near where we are, but there will potentially be that environment. I just don't think we're there. So I'm going to be converting my dollars into Bitcoin and eventually gold. Again, I think over the next, I don't know, maybe it keeps going and maybe I missed it, but I do think the gold and silver, probably it's going to take a little bit more time to digest. I would think. I don't know, but I would think.
Yeah, we'll see. Spot gold, or not spot gold, physical gold.
Yeah,
interesting. Yeah, honestly, that for me, I kind of agree there. I don't mind gold and silver, physical as well. But the one thing, the more that gold and silver run, and the more I hear these conversations about these haircuts you got to take to sell, if you're going to sell your physical gold and silver, like the more like the liquidity factor of Bitcoin becomes appetizing to me. I'm like, wow, there are truly a couple specific, unique factors of Bitcoin that are truly epic, and not enough people know or care about them yet. Obviously, otherwise it'd be more expensive to buy Bitcoin. But there will be a time. I guess in my head, I see the remnants of gold where gold and silver just were so flat for so long, and then all of a sudden everyone's like, "Wait a minute, this stuff matters. It does matter that it's physical. Like it does matter." And then all of a sudden the price shoots up. The people issuing the gold and silver are able to charge crazy premiums. And I'm like, dude, there will be a moment for that for Bitcoin. It'll be some other setting, some other situation. But there will be a time where people are like, oh my God, I need something liquid now. I need something I can sell now. I mean, send across now.
It's also like, again, that time preference, time horizon. I was buying gold back when no one was talking about it. I think my average cost basis is like 17 or 1800. I'm up 180%, even with the pullback on my gold. If I wanted to go sell it for dollars, which I don't, but if I wanted to and I had to take a 10% haircut, I'm up 170%. You know what I mean? Like, do I really care? If you're trying to trade gold, then yeah, definitely do not buy physical, because you take the initial haircut, and then trying to exit, you take a haircut. So like, yeah, trade GLD or SLV or something, but that's not how I'm trying to do it. So
yeah, it makes sense. Right on. Well, Robert, look, fun streams as always, man. I love chatting with you. Every week, these are a ton of fun. I learned a bunch. And for everyone who's back at home, thank you all so much for tuning in. Can't do these streams without you, whether you're listening or if your name is Robert. And we have spaces and streams every single day here at Wolf. Robert has YouTube videos. So if you enjoyed today's stream, he does a million of these sorts of videos and breakdowns, very high level stuff on his YouTube accounts. All that stuff is in the description if you're on YouTube. If you're on X, just go to his handle right above us. I tagged him. You can give him a follow. If you're interested in the Rex Shares 2X Inverse Bitcoin ETF, by the way, that link is down below. If you guys want to check that out and find some more information. Big shout out to Rex for sponsoring the show, as always, man. And we'll see you guys all next one. We've got a stream or a space coming up in like an hour, talking RWAs, tokenization. Then we got the normal market talk space with the traders. We got mining later on. And I think there's another crypto discussion as well. And then we have a normal day of Friday spaces as well. So we'll see you guys there for that one. Have an amazing day, everybody. Take care.